Hey, Cindy and Sarah, can you hear me okay? Huh. Let me see if I can get y'all to unmute. Sarah, can you hear me? Cindy? Angela?
Yes, I can hear you, Bob.
Oh, good. Okay. Whew.
Oh, look at the holiday colors. I tell you, you're
I
doing
can hear you as well.
Yeah. How's everyone doing? Happy holidays.
happy holidays to you. Wow, I love that. See, if I was thinking, Bob, I could have done something to my PowerPoint and made it colorful.
Well, I was going to put a big pizza there, but I figured it'd probably be more appropriate this holiday stuff. So,
Oh, it looks good.
how's Pick doing? He's doing okay?
He's doing fine, feeding his face. You may not have heard that term before.
Oh, not me. Oh, no.
Fighting off the COVID-20.
Oh. We're finally getting, apparently we're finally starting to get these vaccinations now. This you know,
Yeah.
I'll kind of hold back and kind of stay away from people for a little bit. I want to see if those things have any side effects. This should be interesting.
Did you read about the four individuals with Bell's palsy? Was a trial group somewhere out of the country, but still,
What happened?
they developed Bell's palsy.
Oh, you mean from the vaccine?
Yeah. Mm-hmm.
Really?
Yeah, I can send you that article. Fascinating.
Okay, Sarah, as much as I care for you, I say we let Pick go first.
I agree.
Okay.
Oh boy,
Ugh.
you're so right.
Oh, no joke.
Yeah, that's just like, it's like,
Yeah, that's
oh no.
yeah, I think I'll hold off. I don't, especially when like stuff like technology comes in, I don't like to be first, to get the stuff. I like to see the bugs get worked out first.
Yeah, but these bugs may be working internally.
Yeah, yeah, really. I hope it's not too. I hope it's actually pretty effective. I hope the side effects are almost none or none.
Yeah, truthfully. Mm-hmm.
Now, I was talking to one of our members. His wife is a nurse at Lexington Medical Center. She said all the beds are full, all of them. So I guess the news is telling the truth. So I'm always wondering, is the news telling the truth, or are they understating things so as we don't get alarmed, or are they overstating things just to sell the news? It's one of those. So I see Prince Panford is on. Mr. Panford, it's been a while. Let's grab a bite to eat sometimes. So yeah, Prince hadn't been around a while. This guy's a mover and a shaker. He's a good man to know.
Awesome.
I'll send you a tip later.
Oh, he will not turn it down. I promise you that.
Oh, is Prince talking right now?
He makes a living doing that. He's the recipient of tips. We know you, Bob. Your reputation precedes you.
Oh, that's actually a scary thing. Yeah, that's why I don't turn on my camera on these meetings, because you have no idea how I'm dressed or if I'm dressed. So,
oh Lord.
Yeah, I don't want to strike anyone blind. Okay.
Oh,
Anyway, let's maybe wait another minute if that's okay, Sarah.
Oh, Bob, this is an overview as it relates for me. So I'm okay. I take 15 minutes and I'm finished.
It's a pretty important overview. Can you see my screen okay?
Yes, I can see it. Mm-hmm.
Okay. And again, I appreciate you doing this, Sarah. I'm going to keep my attendee list open here as people pop, then I'll kind of admit them in.
Yeah.
But okay. Well,
yeah.
This is the pre-meeting meeting, if you will. And I generally, I'll only show things, in my opinion, that are worth purchasing or whatever because I use them myself. In this case here, this is the Legal Shield pre-meeting event, if you will. Now, one thing about Legal Shield, in fact, I just used them today. I had a trademark question because I want to trademark several names. I'm trying to get several other things going, and to trademark them, I had questions about them. I got some really good consultation from Legal Shield on that. But among other things, as you know, we've had a COVID-19 pandemic going on, and all of a sudden, you know, there are all sorts of potential lawsuits that can come out of it. Like employers suing employees for infecting the workplace with COVID-19, or vice versa. Okay. So anyway, that's one of the things that I've never lived through pandemic. I think the last major pandemic was like 1918, wasn't it? The Spanish flu, if I recall. So anyway, it's good to have legal support with regards to stuff like, especially the unknown, which we're now living. I mean, folks, we're living in history now. You know, this is history. One day, if I live that long, you know, I might see some kids like 3 generations younger than me. I'll tell them about the great pandemic of 2020, 2019. Anyway, also on occasion, actually more recently now, more and more frequently, I'm starting to see legal questions being asked in our Facebook groups. This one here was specifically, does one person have the right to evict a mobile home from a land owned by 2 different people, where one person owns the mobile home, but not the other one, but the other person owns half the land? You know, I mean, that's a Legal Shield question. And that's not something I want to really, you know, post in a Facebook group. For one thing, I can't, I'm not an attorney. Okay. Now, on a more complicated note, okay, Sarah, have you heard of Tony Shea? This guy,
No.
he was CEO. If you Google this guy's name, he was CEO of a company called Zappos. Okay, Zappos pioneered online shoe sales. Okay, and Amazon bought him out for $1.2 billion, and he retired at the age of 46 just past August. Okay, and anyway, his net worth was estimated to be about $840 million. Now, this is a guy with $840 million. And I mean, it's a combination of cash, real estate, other investments. And take a look here. All his itemization of his assets are done on sticky notes, you know, LLCs, and probably a lot of it undocumented. Okay. Take a look at this. Without a will. This guy died without a will. All right. Now in South Carolina, I Googled this in South Carolina, you can buy a will software for $90 about, okay? Or if you use an attorney, okay, because even if you use will software, if you get someone contesting, you still have to talk to an attorney. Now, the average cost of a will using an attorney is about $940 to $1,500, okay? A Legal Shield plan, which goes well beyond just getting a will, it's like $25 a month. Okay. This is a close to billionaire didn't want to spend $25 for a will. Okay. So this is going to be a mess. Okay. He was paying people. He was setting up a community in Park City, Utah, where he was paying people to leave their jobs to join him in this resort type community. Okay. I see people coming out and claiming parts of his assets, you know, because there's no will to say it goes to such and such. This is going to be a mess. You think the Marilyn Monroe situation, Elvis Presley, whatever, you think those were messy. This is really going to get messy. Anyway, now, Sarah, this is for you because I know you're a rather well-humored person. Okay. On my Facebook page, I like to post these half joking life pro tips. Okay. I mean, they're meant in jest, but really, I guess you could really make them work if you wanted to. So this is my life pro tip of tonight. Okay. Okay. When a wealthy person dies without a will, submit a claim for assets and settle out of court for a fast payoff. Okay. Now, like for example, okay, take a look at my face here, Sarah. Do you think I kind of resemble Tony? Okay, I think I do. Okay. So, anyway, now now I could give them a choice. And if I was serious about this, I'm really not serious about it. But if I was serious about this, I could, contact the Shea estate or the executors now and say, hey, look, you got a choice. You can spend about $10,000 or more to fight my claim to some of these assets, or just give me a couple thousand, to settle out of court. Okay. Which is really what like these ambulance chasing attorneys do. They want a quick settlement. They don't want it to go to court. But anyway, so it's meant half in jest, but the more I think about it, I have to think about this. I might submit a claim and just see if they throw a couple thousand my way. Okay. So,
I think that would be a great idea, Bill. Bob.
yeah,
I mean,
it boggles my mind that this guy with these kind of assets didn't have a will. That just amazes me.
Yeah. Sad.
But okay. Anyway, tonight we have a Legal Shield regional director, our local regional director, Sarah Mitchell. Okay. Miss Mitchell was formerly trained in business administration and accounting. She's a former manager at Bell South, so she's well versed in management duties. Now, Sarah joined Legal Shield in 1998 and is now full time to not only sell the services but also provide support to them. Okay, Sarah regularly trains on using the Legal Shield attorneys as well as the ID protection services, especially for small businesses. Okay. One of Sarah's specialties is helping small businesses at very affordable costs, sometimes without any cost to the employer, to set up legal protection plans and ID protection plans. Okay. I think I'm very fortunate to have Sarah presenting these Legal Shield plans. I actually went under Sarah with this, and I use it at least twice a month. Anyway, Sarah, let me transfer screen control to you.
Okay.
Let me see here. Make you a co-host.
Okay.
Okay. Can you get control there?
I can. I want to continue. I'm going to say yes.
Oh, there we go. Thank you.
Yeah, I should be. Okay, 1 second. Can you see the screen?
Yes, I can.
Okay, great. Well, then we're good. We're great. Great job.
Thank
you. Absolutely. Well, I'm showing I like to certainly be where I stay on point with time. It's about 9 after, 8 after, and I certainly will be finished before 7:30 because this is just an overview. Well, the family, all of you business owners, entrepreneurs, Bob and I, we thank you. And Bob, I would be remiss to not thank him for all that he does as it relates to just helping. I mean, not only are we business partners, but we're friends, and that's more important than the business partner aspect. And he's always in the helping business, and that's how we connected, helping. And now we jointly help more. So that's our ambition, our goal. And I can just share with you, yes, I've been with Legal Shield since 1998. And I had life, 40 plus years of life before the introduction. And now I've had 25 years since the introduction. And it's like being on two sides of earth. One side is like earth and the other side is heaven. And I'm being real transparent with you with all of the life events that I experienced before Legal Shield. And maybe like some of you, I just chose to not want to pay $300 or $200 for an attorney to review something. So I signed off on many things, and some of them came back and haunted me. So knowing about the service, I'm very convinced that everybody can benefit from it, and we're educating. I love the fact that Midlands REIA can help protect you. I am the mouthpiece for Bob a lot of times, but if you want to go to the site after, please do that. As business owners, what do? We help. And yet, a lot of time we're in need of help, and we don't yield to that. So tonight I'm going to highlight how you can just tap, call, equal access. And that's what Bob is doing. As he stated, we can just call and help other business owners to be able to call and talk with an attorney without having to wait for one to return their call. You can do it at a stop sign or a light. That's how simple it is. We know from statistical data that, nearly 60% of small business owners said they experienced a legal event in the past 2 years. And those statistics are even higher now with COVID having been part of our life for the last 10 months. Most of them, reported an average of $7,600. Well, that's real money that impact Mr. Small Business Owner. We have the same issues as big businesses, but a lot of time we don't have the deep pockets. Some of the earlier business luncheons that Bob and I did, or breakfast meetings, the top 10 issues faced by our business owners were debt collection issues, contract review, document review, supplier concerns, internet breaches. Those were some of the things that we had discussion around. But guess what, family? After COVID, that changed in a big way. Those still remain, but there's a twist to it, and it's only going to continue to get worse. Now, since COVID, yes, it may be a debt collection issue, but the question is, should I still send a collection letter? Should I report, that bad debt to a credit repository? Again, breaches of contracts, do I have any recourse because of COVID? So now there are another set of governances and legislations. And what does that mean? Well, we're happy to say you can call and talk with your law firm. Even now with the vaccines, we're excited to hear, vaccines they're on the way. But again, there are going to be some questions as it relate to employers and employees, because what if one is opposed to the vaccine, yet the employer is saying this is a requirement? So, it goes on and on and on. So what we do, we are providing you peace of mind, protection, and security. This is one of our plans. And by the way, we have been told that there will be an increase in our business plans effective January the 1st. So if any of you would like any clarification so that you can make an informed decision prior to January the 1st, please let me know. I'm happy to do that. But just imagine, for as little as $39 a month, you having access to your law firm with debt collection concerns, contract review, consultation. It doesn't matter. They are there for you. And it goes up with $89, $149. We have found from our Midlands REIA family that the vast majority, Bob as well, we're looking at basically the home business supplement added to your legal plan, and it's meeting the needs in such a huge way. So I'll highlight that home business supplement plan. It's only $9.95. Can you imagine paying $9.95 and having the ability to say hello to an attorney about anything? Here, we provide that on top of your $24.95 family coverage, meaning you're only paying $35 a month. $35 a month, and you have unlimited telephone consultation. As Bob stated, he spoke to this afternoon to the attorneys. He didn't pay billable hours for getting that information. And I have spoken with them, calls that have lasted 30, 40 minutes, no billable hours. One of my members called the other day. Guess what happened to her? What could happen to anyone on this phone? Well, she has a copier. You may not have a copier, but you may have signed a contract of some sort. She did not realize until this month, that they had increased her copier payment $83. The salesperson initialed it and made that change. When she made that discovery, there was a dispute, but yet she was paying that. Where did she go? She called the law firm about that. I had another member, she did a lease purchase agreement, and the person wanted to deny paying her for the item that they agreed to have in their little facility. It was an event planning type situation. So she did enter the agreement, $300. And guess what? Because they didn't make money from that, they felt that I'm not going to pay you. Well, that's not a lot of money. How many of you would call an attorney about a $300 issue? You just say, well, forget it. You're not happy. Guess what? She called the law firm. They intervened, sent a nastygram demand letter. And the next thing, she had her $300. She sent me a copy of the $300 check that had gone to the attorney's office, and now they sent it to her. So again, that's helping members with peace of mind, protection, and security, in a big, big way. So I just want you to know, for as little as $9.95, you can have access to help you with contracts, to help you with documents, to help you with questions as it relates to growing and sustaining your business with debt collection as well. And on top of that, you get access to a tax attorney for Schedule C and Schedule E audit. That's huge. I've used that. And it makes a difference when you can have a tax attorney to intervene. So that's what you're looking at there. And as I stated, your $9.95 is added to your personal family plan. Well, again, on the personal side, COVID, if that hasn't caused individuals to start thinking about all of their estate planning, I don't know what will. Here, with this family plan, your personal plan, you have access with unlimited telephone consultations, contract review, document review, IRS audit representation on the personal side, civil and trial defense, which is huge. We even cover family and domestic services, meaning that for as little as $24.95, one can have the attorneys assist them with an uncontested divorce, adoption, separation, all of that, and more. So, I mean, when you think about that does come with a 90-day wait period, but so what? I mean, 90 days doesn't take that long anymore. So just want you to know I'm highlighting the services here, but with this, you can tap, call, and start your will life estate planning from the comfort of your home. I mean, like tonight. That's what we're talking about. Also, with speeding tickets, there. Have I used that site? Absolutely, and I was ecstatic. They negotiated my points, negotiated my fine, and that meant a lot because a 4-point ticket, you can call any insurance company and ask them how much will that increase my premium. It will be a couple of dollars there, upward of $2,000 to $3,000 over that window of time. So that's what you're looking at, and why we're so excited to just share the information with you. Also, identity theft. That's another component, another service that we offer. It too is an app on your phone. I know all of you have some form of identity theft protection in place. However, I would encourage you to do your due diligence and inquire about exactly what is it covering? What is it going to do in the event you experience medical theft, Social Security, DMV, criminal character, any of those? We are proud to say that we have to date the most robust identity theft restoration coverage in existence. And we did receive the cybersecurity award for that this year. For $15.95, you have restoration. That's what's important, entrepreneurs, business owners, family here. Restoration. And that's for all areas of identity theft, the dark web, I mean, social media, all of that, the public records, all of that is there for you. Driver's license, passports. I'm supposed to be out of the country in January. I don't know if I'm going based on COVID, but it's like if I were to take that trip to Maya Riviera, what if I'm in the airport and there's an alert? How does that impact me? What if I can just tap an app and have access with investigators to start researching that? So that's what you're looking at. One of my colleagues in North Carolina, she was detained out of the country for 14 hours. It was one of those alert situations. If she didn't have the service, they were about to take her to jail. She escaped that part because she had the service. So it goes on and on and on, but that's what you're looking at here. Our people, social media, I mean, where your investments, your 401k, all of that. I can't even go through how comprehensive it is. For $15 a month, we can't even go to Zaxby's for $15. Your social media is part of that platform, which is so huge because everyone has a presence there pretty much anymore. All of that is included with the monitoring your reputation is what we're looking at. We have security for the home, security for the phones, the cars, the computers. The question is, where's your security? And this is not credit monitoring. This is the U factor, and it comes with $1 million restoration. This is where I was sharing with you that we're proud to say that we won that 2020 Cybersecurity Excellence Award for having the most robust identity theft service in North America for this year. Gun owners plan, some of your carriers. I spoke with a CWP instructor this afternoon, and of course, she's having where all of her students have this education here on the gun owners. So yes, you may be an authorized carrier, but with that can still come a lot of issues as it relates to needing advice when it's open in a certain area perhaps, or what if trial defense come into the picture? You know, even if you have to use it, or if you don't use it, just show it. You could run into some consequences. You may know commercial drivers. We help them in a big, big way, and so excited to know that they can have an umbrella of protection, moving, non-moving violations, all of that as they continue to go about life, day-to-day life events there. They come about, tragic accident, they come about. So what if they can have this service and now they have access? Share riders. How many of you know individuals who are Ubering and lifting and what are some of the DoorDash and the Papa John's delivery person? Well, they are out there doing the best they can to make ends meet and that side hustle. But situations can come about. We can help them. Some of you may know of individuals. Please refer them to Bob, refer them to Midlands, have them, Maria, have them call me. I'll answer questions on behalf of Bob. And that's what you're looking at so that they can have an umbrella of protection for them. And many of you have heard about Legal Shield. A lot of people just don't really know how comprehensive our services is or services are. And so that's why Bob and I, we continue to educate as a pre-meeting piece every week on this call. And the young lady that I spoke with earlier, the CWP instructor, she said, yes, I heard about the company 10, 15 years ago, but I just didn't know what all you did. And it's like, yeah, this is what we do. And so again, was she impressed? Yeah. So I'm just sharing here tonight. I could go on and on with stories, how I've used it on the personal side when when I moved into this home and wasn't able to use the cell phone inside the home. And it's like, oh no, that's not right. I think I should be able to use the phone without having to go on the deck of the porch. Well, they wanted to charge me an early termination fee. That was in June 6th, 2001. What did I do? I called the law firm. And what did happen? Well, within a couple of hours, I received a call saying, ma'am, you're out of your contract and we're not charging you that $175 termination fee. You can tell about by the amount how long ago that was. So again, my daughter, the twins, you said, well, what about the personal side? Well, things, life events, the twins, they were being bullied in school. And again, fight pursued there on the bus, fight in the backyard. Young lady just definitely was on their trail. And my daughter got no satisfaction. But when she called the law firm and they intervened, we all sat in the principal's office with the principal and the assistant principal and the assistant superintendent. We got it all resolved. And the young lady, the attorneys wrote letters, never had any more problem. So I'm just sharing with you, it's about life events. I have used it from being local here to contracts being reviewed, moving into office area, and there's the common area, and it's like, okay, what if, something happened here? My think about the fact too, some of you may have children. Well, she lived at a quad, USC, one of their quads, and vacated. She was the last one, so they wanted to assess all damages to her. That would not have happened if someone had called, if she had called the law firm first, that wouldn't have happened. She did not think about it. And then when she told her mom, it's like, this is the money I'm paying. She said, well, let's call a law firm. Even after the fact, they intervened and those charges were not just all put on her because she was the last one. So, I mean, my business owners, I mean, we have had so many situations where contracts, the fine print has been there and was not in that business owner's favor. But by having the service, calling the law firm, they were able to get beyond that. So, Bob, I'm just going to go ahead and conclude and turn it back over to you with where we are, just looking at sharing the information here. And I hope that everyone will just go to your website and continue to research. Allow me to answer any questions that might be there on the minds of those who are listening, or your family members or friends. And I do a lot of will workshops. We can help with that upon enrolling and activating the service. So I thank you so much for the opportunity to share. And I conclude with saying happy holidays to all of you. I probably won't get to talk with you anymore this year unless you give me a call. But just think about a love letter that you can put in place, possibly to not just protect yourself, but protect your investment. And more importantly, your family, because they too can be in some interesting situations without having those estate planning documents in place.
Well, thank you, Sarah. I appreciate that. The as I mentioned, I use Legal Shield about at least twice a month myself. The first one I mentioned, I had a trademarks question, and I know which way to proceed with that. The second one, I had been going on a false assumption for a number of years about pre-foreclosure investing in Florida. So I got that one pretty much answered. So now I know which way to proceed with that as well. But thank you, Sarah. I appreciate that.
No, thank you.
If it's okay, let me go ahead and steal back screen control from you. Uh, how does that work? Do you have to release screen control? Let me try this. I'm going to withdraw the co-host permission. Okay. Okay, and let me see if I can. Here. Okay, here we go. Sarah, can you see my screen okay? Can everyone see my screen?
Yes.
Oh, okay, great. Okay.
Yeah, it's back on you, Bob.
Whew,
I was
okay.
muted. Okay, sorry. I'm muting.
Okay. Okay. Well, this is the last Midlands REIA meeting for the year. I was debating holding it in person at the hotel, but looks like the COVID-19 spike came in again. So I didn't want to jeopardize anyone or their family, especially during the holidays. Now I don't. Apparently the vaccine just arrived in Colombia and they're starting to distribute it. So hopefully, I'm guessing maybe March or April, we may be able to start meeting in person again. Okay. I think that's preferable because there we have deal presentations and stuff. But I appreciate everyone's patience, and I hope you're learning something, at least during these online meetings. Liability disclosure. On at least as far as I know, there's no attorney or licensed financial advisors on tonight. Okay. Now Jeff is probably as close to qualified. Our main speaker tonight is qualified to speak about what he's, the taxes and whatnot. Okay. I am not. If you have any questions about the legality or financial wisdom of anything you hear tonight, please seek qualified help because technically I'm not it. Okay. REIA goals. You notice I changed this to 2021. All right. It used to be say 2020. Nationwide. Okay. This is kind of a given that out of all the people, the common people like us, not the people who have a bunch of money already, the common folks like us, out of all the people who jump into real estate investing, only about 3% ever do a single deal. I heard it's a little bit higher in Colombia, but nationwide, it seems like 3% is the common number, right? That's a pretty bad number. That's a pretty bad statistic. One of our goals is to get that success rate to at least 50% in our area or higher. Okay. And the way we anticipate on doing that is to provide more workshops and more and better. Now, Carlos Barrera suggested the word cartels. Okay, really subgroups. Okay, you thought cartel sounded a lot more, well, anyway. Also, now, as I mentioned before, that 97% failure rate, you're going to have gurus out there. I could name a few off the top of my head. I'm sure you can too. For a while there, they're coming to town and hammering Columbia pretty hard. Okay, what they do is they sell you on a 3-day workshop. Then there they give you the big upsell into coaching programs, raising, going from $5,000, $10,000, $25,000, $50,000 or more. Okay, I know of at least one of our members who went into one of those and got himself into $60,000 in debt. And the number of deals he did was pretty much nil. Okay, but he's still stuck with the debt. This business doesn't have to be expensive. Okay, just to get started. Now, don't get me wrong. Okay, a good coach can take you well beyond what you're going to learn at any REIA, including this one. Okay, but I suggest what you do is you learn the basics for a very affordable cost, because you can earn that money first and then decide if you want to go up, upgrade into one of these expensive coaching programs. Don't put it on credit cards or any other form of credit. Okay, that's my suggestion. You do with that suggestion is what you want. Okay. For beginners, one of our goals, actually our main goal, is to get you up and running independently from anyone else as soon as possible. As much as we'd like to keep you around, and pay, each year, long time, pay annual dues and whatnot. Okay. We know that's not possible in many situations. People move or whatever. Okay. And we just want you to get you up and running independently from anyone else, including us, as soon as possible. So even if you move out of state, you can take what you learned here and take it with you, port it with you. Okay. For advanced investors who do stay in the area and you decide to stay with Midlands REIA, we want to provide the best continuing resources possible, most up-to-date stuff. Okay. Real estate investing, in my experience, I've been involved with this full time since 2005. So I went through the major depression of 2007, 2008 holding property. And I lost a lot of money then. I learned a lot of lessons. Okay. What I've noticed though is they cycle. It's cyclical. These people who are saying, oh, this is a new technique. It's not an old technique. It's a technique that was done before. They just shifted it into what works best in today's environment. Okay. So really, unless they have something really technologically advanced, there's really no new techniques in real estate investing. You just have to learn what strategies to use and where. Okay, why the low success rate, this 3% I told you about? I think what it is because the way we get into real estate, it's too easy to get in, so it's too easy to get out. Okay, like if you go to college, okay, and you spend like I don't know, what's a typical college degree? At least $100,000 now after 4 years, at least. Okay, that's a pretty tough nut to say, okay, I'm just going to punt it. And by the way, which I did. Okay, my formal training is as an engineer. Okay, but it's a pretty tough nut to say, okay, I'm going to just throw that away. All right. And the way we get into real estate, there's really very little effort and money to get into it. So it's just easy enough to say, well, I didn't have a whole lot into it, so I'll jump right back out. But also, not only that, it takes persistence. Okay, you can see the difference between success and failure. By practicing a few simple disciplines every day over a long period of time, you'll eventually reach success. If you keep on making errors in judgment and repeating them over and over again, over time, you'll see failure. But you'll see along this timeline here, success and failure can look a lot alike. All right. Lots of people, I believe, quit somewhere in here right before they're going to experience either success or just pure failure. And I heard someone consistency is key. I once heard someone say, you can quit anytime. Why quit now? All right. So how does a good club or association help? I'm open to more ideas. I'd love, I can't even begin to say, I don't know everything. So if anyone has suggestions, I'm open to them. In my mind, a good club or association will offer an abundance of resources, provide great networking, which, as I mentioned, is kind of tough to do online. Hopefully we'll be meeting in person soon. Okay. And we'll get the best networking possible. And a good association will give the best training possible, up to date, stuff that actually works, not just stuff rehashed from Google. I see that a lot too. Okay. And a good association will always seek to improve and adapt. I'm never going to say Midlands REIA is the best. I'm never going to say it's always going to be the best. I'm always going to say, hey, what can we do better? All right. Also, a good association will learn and teach best practices for local investing. I say local. There's some gurus out there. In fact, I got a call today earlier about lease options. Okay, this person was following a national guru who has great advertising. I'm sure you've seen his ads, but what he's teaching will can get you in some trouble here in South Carolina. Okay, a good association will teach the best local practices. Okay, for local what's working in our area. Okay. Now, we are on the major social media sites: Facebook, YouTube, LinkedIn, Instagram, Twitter. But if nothing else, okay, at least join our Facebook deal making group. It's called the Money Mastermind Group, the Midlands REIA Money Mastermind Group. You can either access it through this URL here, this website address here, or if you go right to our website, okay, you go right to our website. Well, you're not going to see it here. On the main pages, that's the members area. So I took that down for some reason. But on the main pages, you can also access it right here. Okay, this, if you click that, it goes right to our Facebook group. And you'll see it's actually pretty active. Not only is this a place to present your deals for possible resale, this is also a place where if you need funding, okay, just put in there need funding, okay, because it was initially meant to match local borrowers with local lenders, okay, and turned into more of a deal flipping group, which is fine by me, all right. Now, in our members area, I keep on getting asked this question: where are the cash buyers? We have 50, I think it's 54. Okay, we might have more now, or maybe less. I don't know. I think one of our cash buyers actually died, so I have to get him off. So it's over 50. Okay, over 50 cash buyers with their phone numbers. Now, please don't call these numbers unless you have a deal to present to them. Yeah, Guy Gant died. He has to be removed. Okay, but yeah, please don't call them unless you have a deal to present to them, because otherwise you're wasting your time as well as theirs. Okay. But these are proven cash buyers. I've seen them buy at auctions. I've done business with them myself. They've been referred to me from true investor realtors. Not all realtors are truly investor realtors. Okay. But there's your cash buyers list. You get a property under contract, you want to wholesale it, just go here and start and let your fingers do the walking. Okay. The typical, we just had a house rehab workshop, was it a week and a half ago? Okay, this is Blair Kobliski, which, by the way, we're trying to get her to start Sandhills REIA up in her area. Okay, because I noticed that some people drive a long way to come to Midlands REIA, the other REIAs here. Okay, so I'd like to get Blair started on hers, and that's going to be hers. Nothing to do with Midlands REIA. Okay, I just want to see another resource, a good resource for investors. This is Eddie Sabina, our contractor. This is an actual rehab. When we do house rehab workshops, we take you through an actual rehab. Okay. We also have creative finance workshops as well. I want to set up a negotiation workshop. Okay. Like a little half day thing, things like that. Okay. That's going to be in the plans for 2021. We're always, as I mentioned before, open suggestions on how to improve. Are there topics you want to see or you don't want to see? Are there workshops we can improve on or add? How about more subgroups, better subgroups? Okay. One way to find what we seek to teach each year, we may not have time always, is if you go here to our website. Okay. Our website, we try to teach a little bit of all of these. All right. And if you hover over that, it kind of gives you a rough idea of what we try to teach. All right. So, anyway, we're always open to how to improve it. Some annual member benefits, okay? Discounts on Midlands REIA trainings and workshops. If we have an external speaker come in with their own workshop, we have no control over that, the cost to attend those. But Midlands REIA, typically, we like to make them free for the members with some kind of fee to non-annual members. Okay, in Blair's workshop case, I think the annual fee, the members got in free, and I think it was like a $20 fee for non-members. And usually when we're meeting at a physical location, it's no door fee to general meetings. Obviously, this being an online meeting, there's no door fee anyway. Access to members area with local cash buyers. Documents, for example, the documents that at least have worked for me. Okay, me and a few others. Okay, you'll see we have documents, templates, calculators. This is all you need to pretty much construct your deals, at least in my experience. Okay. Um, Also, this is a Midlands REIA thing, not a national thing. Okay. Annual members, you get close guidance for deals if you want it. You don't have to take advantage of it. Um, I kind of bristle when everyone says, "Oh, you're a great coach or you're a mentor." We're more reference librarians. Midlands REIA, I like to think, is a good library. I don't know if y'all have a Richland library card. That's one of the best library systems in the nation, and they have great reference librarians. They're not coaches; they're reference librarians. That's what I consider us to be at Midlands REIA. Okay. If you have any more questions, please see midlandsrea.com for more benefits and details. And specifically, if you hover here, there's membership info there, and there's a little bit more detailed information there as well. Now, when you become an annual member, the first thing I ask, and this is up to you, okay? I want to take you through as quickly as possible. 3 introductory live trainings, typically online meetings. Okay. The first webinar, first online training is finding deals with and without relying on realtors. Okay. The multiple listing service and realtors, that is where the inventory is, the houses, if you will, but that's also where the competition is. I think your best deals are going to be when you find those houses with little to no competition. Okay. Webinar number 2 is the basics of all cash purchases and sales. Okay. Everyone's talking about wholesaling now and cash rehabbing. It'd be nice to know what numbers you need to bring those houses in to be able to wholesale or cash rehab and make a profit. Okay. And our third webinar, this is the fun one, creative financing. I love the creative financing one. This is the really fun one. This is where we start talking about subject twos, lease options, seller financing. This is basically buying with none of your own money. Okay. Or very little, I should say, little to none. And each of these webinars or trainings, if you will, is about an hour and a half long. And anyway, there's a couple of y'all on here. We still have to schedule these webinars. Okay, so when you're on here, please send me an email and let me know when you can. All right. Now, pictorially, I didn't know how else to bring this. Okay, the first step is we provide the basic training and tools to succeed. Okay, the second one is you get kicked out of the nest. All right, but you have to. This is up to you. The most important ingredient in this whole concoction is you. You have to take consistent and persistent action. Most important, don't give up. Okay, take the training and the tools that we give you, make it better, add to them, make it your own. Okay. Now, I couldn't find a mother bird who's willing to nurture her young when they need help. So I just had to show a human hand here. Okay. We're here for support as needed. As I mentioned before, we're like reference librarians. Okay. If you go to the Richland Library, as I mentioned, okay, and you ask them to coach you, unless they charge you some exorbitant fee, I've yet to find a reference librarian willing to coach anybody. Okay. So, in my experience, you have to go to them and say, "Hey, I got a question here. What should I do here? What would you do?" Okay. That's what I mean. We're reference librarians. Okay. You have to take the action yourself. And then when you come with issues you need to discuss, you come to us. Okay. Annual membership is $125 a year for one person and $200 a year for a couple. It doesn't have to be a spouse, it can be your business partner. Okay. And normally in a non-COVID-19 time, it'd be free entrance, all benefits. Okay. Free entrance is now, since they're online meetings, it's pretty much free entry. For non-members, when we're meeting at the hotel, the first visit is free, and typically there's a $20 door fee afterwards per meeting. Okay, with no real benefits. And I say no benefits, kind of tongue in cheek. If you call me up, I'll be glad to discuss your deal. Or if you call, like, say, Andy Holland or a couple of our other longtime, reference librarians. Okay, I know they'll talk with you. They're not going to cut you out, but at the same time, please respect their time. Okay, if you're not an annual member, you might not get as much attention as if you are an annual member. And normally speaking, again, you can apply. There's no door fee for tonight, but normally you can apply to annual membership. Okay, this is now, if you get a chance, check regularly our calendar of events. Now, as you can see here, our calendar of events has been pretty sparse lately because of COVID-19. Okay. Normally, I'll fill out things like the WIRE group, the Women in Real Estate group, the Columbia WIRE group meets every third Saturday of the month, I believe. Okay, so they'd normally be meeting this Saturday. Columbia REIA, they've been kind of on a hiatus for a while. They normally meet every fourth Thursday of the month. So normally you'd see this pretty full out. Okay. Because of COVID-19, it's been a little bit sparse, but hopefully once the pandemic passes, if you could, please continue to check our calendar events pretty regularly. Those will be posted. Events that might interest you and hopefully help you as you proceed on your entrepreneurial path. Okay, tonight's interview subject. I saw Jeff check in earlier, our main speaker. This man's an expert at his craft. Okay, he's top of his craft. Jeff Harmon is going to speak tonight about year-end tax tips, basically strategies, if you will, going into the new year, how to minimize your taxes and maximize your income. Jeff is founder and president of TFL Worldwide. He's a business coach. He's been doing this for 17 years and helped hundreds of people. Okay. He's well worth the money to pay. If you have a business that's running that needs a little bit of tweaking, trimming the fat and whatnot. Okay. He's a certified human behavior consultant and a former certified public accountant. And he coaches and advises individuals and business owners to provide proactive tax planning and business coaching services. Basically, he can optimize your business and make it one smooth running machine. And let me see if I can find Jeff so I can put him on. Let me see. Oh, here he is. Let me ask Jeff to unmute.
I'm unmuted.
Oh, okay. Okay, great. Hey, Jeff, thanks for coming on.
Glad to be here. Fired up.
Okay, let me see if I can transfer this over to you. Let me see here. I'll make you a co-host. Okay, do you see, can you screen share?
I sure can.
Okay. Okay, thank you, Jeff. I see your screen now. Great.
How's that? Can you still hear me?
Oh, yeah, that looks great. Thank you.
Awesome. Well, I guess we should get started, huh?
Take her away.
Well, thank you very much for that introduction, Bob. And I really enjoyed your talk, Sarah, also. And for all of you guys on tonight, we're just going to go through some mistakes that people make about taxes. It is that time of the year. So if you do some things this year, it might help you. If you wait till next year, they won't help you this year. They'll help you next year. I'll open up at the end for about 10 minutes or so questions. So if everybody could remain kind of muted and so forth, I'll walk through this, and then I'll open up at the end for maybe 10, 15 minutes to answer any questions people might have. But most people don't understand their taxes. In fact, when I say most, I mean, I would say upwards into the 95 percentile don't understand their taxes. But you got to realize that, Uncle Sam is, he's your silent partner. He came to work with you on day one when you started your own business, decided you wanted to flip some houses, decided you wanted to buy some houses, decided you wanted to make any kind of money at all. He came in as your silent partner. Now, he doesn't give you a whole lot of help, doesn't give you a whole lot of guidance, but he can take up to about 50% of everything you make if you're not careful. And so you really need to plan for him. You need to plan to try to make sure you give him and render under him in your partnership agreement with him what is his, and render unto him only what is his, and not a penny more. And so the purpose of our call today is to kind of do that. And the number one reason that people overpay their taxes, the number one, is they don't plan for it. They just don't plan because they believe that tax preparation is tax planning, and it's not. So I'm going to tell you some things today, and I'm not trying to insult anybody here at all. I'm not trying to, I've been told before I have the gift of insult. And so since I have the gift of insult, sometimes I insult people by telling them the truth because I found that truth is a very insulting thing sometimes. The truth usually hurts before it helps. But if you actually ask a CPA, and if there's someone on the call tonight, I'll be glad to even ask them on the call. But if you ask them, when you bring them their work, are they going to do a lot of deep research for you and look up things for you and make sure that you take every deduction you're entitled to take? And their answer would be no. When you take your information to a certified public accountant or someone that's a tax pro, someone that does tax preparation work, they're there to prepare your taxes, not do any planning work for you at all. So to give you just a simple number for that, let's just imagine that, it's not imagine, it's truth. The average CPA does about 400 tax returns a tax season, which means that 400 people come there from a period of January, actually about February 1st when actually tax season starts, because people don't get their records till January 31st. So from February 1st to April 15th, which is about a 10-week period, that person will, they'll actually do 400 returns, which means they do 40 a week for a 10-week period of time. And the average tax return takes about 2 hours to complete. And so that's 80 hours of work every week for the next 10 weeks. When do they have time to research anything for you? They didn't. That's why they don't do it. And second of all, let's just say that you went to a tax preparer and prepare your business return, your personal return, whatever. The bill last year was $1,000. Well, what if your bill this year was $2,500 for the exact same work? You would probably be pretty upset, because you'd be like, what just happened? Why did that happen? And he would say, well, I was trying to do some research for you. And when I was doing the research for it, turns out it didn't work. We couldn't use it. However, I got to bill you for the time. You'd probably be upset. So most people go to a CPA expecting to get some tax planning work done, and they're not getting any of that work done. That's not what a tax preparer does. He doesn't plan for you. So going to a professional is not necessarily going to get you advice. They'll get you some general advice, but they're not going to do a lot of detailed looking into what you do. So if you look at this quote here from William Rehnquist, it says, there is nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. In fact, he says it's very patriotic for you to do everything you can to lower your taxes, and every American should. And I want to throw some things out there. I'm not trying to be political at all, so please don't go in. I've had enough of politics this year. I don't know about you, but if you go back and you look at some of the tax things out there, Mitt Romney, when he ran for president, reported his tax returns out there, and he made like $20 million that year and paid less than 20% in taxes. In fact, he averaged about 15%. Now, the funny thing is the maximum tax rate of like 50%, federal and state, was probably around $400,000. So how does someone who makes like $25, $30 million only pay 15%? Because he has a team of lawyers and accountants that make sure that everything he's structured in stays in a non-taxable or low tax bracket. And then you look at a situation like Clinton and the Clintons. If you look back on their tax return, they gave like $2 million away, $2,025,000, something like that, away on their tax return that you saw. And $2 million of it was to the Clinton Foundation, which they own and control. So was it really a charitable contribution? Now, see, I'm not trying to be political here, you follow me? I'm trying to point out that there are things that you can do legally to reduce your taxes, but you're going to have to plan for them. You're going to have someone take the time to do some planning for those things. And if it's not you, then who is it? Because it's not going to be your preparer. He's busy. He is slammed. Have you ever been able to get in touch with him on a regular basis between January and April? No, they're slammed. They're working really hard just in the process of preparing returns. And preparing returns is not an easy job. So therefore, it's very, very arduous that they need to do that job, and they need to do it well. And so they're not doing a lot of planning for you. All right. Look at some of these tax brackets and realize that you can pay some serious money. I mean, you start giving away 37% of your income to anybody. When you start giving away 25% of your income to somebody, someone taking a quarter of what you make every dollar, that's it's pretty rough to think that you don't want to plan for this. And I'm not being political again, but if Joe Biden is sworn in as our president, he has point blank said, I'm going to raise taxes. Now, he has point blank said it politically that he's only going to raise it on the top 400,000 people make $400,000 or more. And that's not a true statement. He's going to raise it on everybody. Okay. He said that politically, and I'm not attacking. Okay. So I'm not trying to offend, I'm just telling you, every politician in the past, when they try to say they're going to attack the top, they attack everybody, and everybody ends up paying more in taxes. So when someone says, I'm going to raise taxes, Bush did it, George W. Bush. So go both ways. He said, read my lips, I'm not going to raise your taxes. And he had to reverse and raise taxes. We raised taxes across the board. So Biden has said he's going to raise taxes. So in 2021, you're not going to keep as much as you earned as you did in 2020 and before. which means you need to do some planning. And that's not a political statement. That's just a true statement. Okay. All right. Audit paranoia. The second thing that you go see your CPA about typically is most people want to make sure that they have a professional preparing their returns so it's done correctly. So if they ever get audited, everything will be okay. Well, that's actually something the CPA doesn't do either, because he actually gets you to sign your own tax return. And then he actually gets you to sign an engagement letter typically that says you have all the accounting records to back up and support what you gave him. The only challenge is you don't really know what that is. Most people don't. And the rules for the when you're going to be examined are very different than the rules when you actually prepare the return. And so as a simple example, I'll throw this out there to try to teach my point. Let's just say that you went down to Lowe's and you paid $500 to buy some paint to paint your office. So you went down to Lowe's, you wrote a check for $500 out of your business account. You have the receipt from Lowe's and your accountant put it in repairs and maintenance. You would think that you are quite good if you got audited. If you got audited, you'd be able to show the check to Lowe's for $500. You'd be able to show the receipt that you bought paint, and you think you'd be perfectly fine. Well, the only problem is there are two unofficial laws that the IRS follows when they're doing audits. If y'all remember the movie that had Tom Hanks in it, and he talks about, you can't handle the truth. You remember A Few Good Men is the name of the movie. There was another scene in that movie where they were talking about giving something to somebody where they hurt them a little bit, but they really don't. You're saying it was a code red is what they called it. And a code red's when your commanding officer told you to do something, but it's behind the scenes kind of thing. You weren't supposed to know about it. And so in the scene, in that Kevin Bacon is the officer, and he talks about, show me where in this manual for everything does it say code red? And the guy's like, well, a code red is not going to be in the manual because it's kind of like an off the scenes thing, whatever. He said, well, if it's not in this manual, then it's not something the United States Marine Corps says we do. And all of a sudden, Tom Hanks grabs his little book. You follow me, comes back and says, show me in here, Sergeant, where, or Private, where in this manual here is the mess hall. And the guy's like, well, the mess hall's not in this book. Wait a minute. You mean to tell me that the whole time you're at basic, you never got a meal? No, we got 3 squares a day. He goes, well, how did you know where to go to find your meal if it wasn't in this manual? He said, well, I guess I just followed everybody there. Now, what I point out is there are a lot of things that are official and then they're unofficial. So what I'm about to tell you is that unofficial rules that are in an audit, they're the laws. They're called the law of the burden of proof and the law of recollection. And the law of the burden of proof says that if you have all the documentary evidence that's required by law, required by the code, then the burden of proof is on the IRS to disprove a transaction. But if you are missing an element, then the burden of proof shifts to you. Now, the other thing, the law of recollection states, it's a common sense law, that the sooner something's documented, the more reliable it is. Well, when you get examined by an IRS agent and they're auditing your tax return, they want to see, your receipt for it. They want to prove it hit the bank. So the $500 that you wrote to Lowe's is perfectly okay. You could have the return check or the canceled check that shows that it went there and it was processed. And they want to see the receipt. And the receipt needs to have 4 elements: the time, the place, the amount spent, and the business purpose. Now, in my first example to you, you didn't have anything written in the memo line. You just classified as repairs and maintenance, but you didn't write anything in the memo line saying paint for office. You didn't write on the receipt saying paint for office. So technically you're missing an element. And here's what I've seen the IRS do. Well, I think that paint's for your house, sir. Well, what makes you think it's for my house? Well, you didn't write anything down. So most times people don't write things down as personal. So I think you bought that house through your business, you're saying, but it's really for your house. So I'm denying it. Now, the only problem is the transaction's 2 years old. And if it's 2 years old, how are you going to prove a 2-year-old transaction? And you're not. So because you did everything you thought was the right thing, you're trying to follow the rules, you're not trying to break anything, you're not trying to do anything wrong, you just lost a perfectly good deduction. So let's be devil's advocate. Let's say you went down to Lowe's, you bought $500 of paint to paint your child's room. It's a total personal expenditure, but you're going to write it off through your business because nobody knows. And you're going to even be smart about it. You're even going to write on the memo line, paint for office. You're even going to write on the receipt, paint for office. Is there any way you're going to lose that deduction in an audit? And the answer is no, not unless you confess, which I don't really recommend, but I also recommend that you don't do that. You don't lie. So therefore, it brings up an interesting thing. If you lie and say what it was for, but you have all the documentary evidence, you'll get away with it. If you tell the truth, but you're missing something, then you could actually lose a perfectly good deduction. Because what the point proves really is the IRS doesn't care what you deduct. They care what you document. See, the IRS are compliance officers. Their whole job is to make sure you're compliant with the law. And the law says you have to have 4 elements. Now, this is a rhetorical question because I don't want you to respond now, but how many of y'all don't have all the receipts documented properly for your business deductions? And if you got audited, you could show the bank statement, you could show the credit card statement where it cleared, you could show the receipt, and you could show the business purpose. And if that's the case there, then you could be audited and you could lose all those deductions. So we call this audit paranoia. And audit paranoia should really exist because you know what? If you're not documenting things the right way, you could be in trouble for an audit. Well, the problem is you think your preparer is going to protect you. But your engagement letter that you signed said that you have all the documentary evidence, but you don't. So therefore, he's not held accountable. He can put anything on your return he wants to put on your return as long as he says you gave it to him. And as long as you provided to him, he can deduct it. So you could tell him you drove 15,000 miles last year, riding around trying to do real estate deals. But if you don't have a log for it, if you don't have all this information you need to have for it, you can't deduct it. This also brings up a very interesting statistic. If you look at Schedule C's, 100,000 to 109, it's about 2.4%, 2.1%. And then look at S corporations, 0.3. So you're trying to tell me that if I change my structure of business from a Schedule C to an S corporation, I could drop my audit rates by 7 times? And the answer is yes. However, S corporations don't allow for capital gains treatment of real estate deals. So therefore, they don't always fit the situation. But how come you can't operate both? Well, maybe you can. You need to get some tax advice on that. You need actually somebody that can research your situation, try to help you with that. If you don't, audit risk is a real problem. And when I say that, it's because, yes, you only have a 2% chance of being audited, but most people couldn't survive an IRS audit because they don't have the right documentation. So don't go down that road of saying, well, I'm probably never going to get looked at, because you will eventually. And if your records aren't in order, you will pay tremendously. Yeah, the IRS is one of those people that you don't mess with. And when I say you don't mess with them, because, and Sarah will tell you this, you know what I'm saying, and with the legal shield stuff, you can do, if somebody does something to you and they take $500 from you or something, you're probably not going to hire an attorney and go after them and everything, because it'll cost you more money to do that. So in other words, you're not going to be taken advantage of for $500 and spend $2,000 on an attorney to get your money back, which is why something like Legal Shield really works out really well, because you don't have to do that. But if you had to hire a lawyer, you would not go after somebody that the lawyer fee wouldn't even be covered. But see, you take $5,000 from the IRS and they have an unlimited budget, and they'll spend $100,000 coming after you. See, it doesn't make logical sense, but they're a government agency with unlimited power. So therefore, they'll spend $100,000 to collect their 5. So don't think you're a little fish. They're a compliance officer. Let's move on. I brought it up and mentioned it just a little bit at the same time. Wrong business entity. This is your 3rd biggest mistake people make on taxes, because you can have multiple businesses. And you can have different types of business. So you could own a C Corp, an S Corp, a partnership, and a sole proprietor. And I didn't mention LLC and everything else, because most people that are LLC either operate as a sole proprietor, they operate as an S Corp, or they operate as a partnership, or they operate as a C Corp. But you can have different business entities. Each one of them has a tax detriment, and each one of them have tax benefits. And this is why wealthy people, if you want to call it, or people that are well diversified, keep their taxable income low, because the tax rates are very different for each one. The tax rules are very different for each one. Well, just because you have one doesn't mean you can't have another. And just because you're in one now doesn't mean that you shouldn't change to another. So therefore, having the right entity is very, very important. Very, very important. And you need some advice on this. So do your own advice if you want, look it up all you want, or get someone that knows what they're talking about and can help you with this situation. But having the wrong entity could be really, really costly. Having the wrong business set up and having it set up the wrong way is something that really costs you a lot of money. All right, wrong retirement plan. Just like wrong entity, so many people have so many things out there to choose from because things have gotten a little more complicated in the world today. There are simple IRAs, there are SEP IRAs, there are 401k IRAs, 401, there's solo IRAs, there are all kinds, there's self-directed IRAs, there are Roth IRAs, there are traditional IRAs. Retirement plans are a really good thing if used the right way. Because what retirement plans in general do is they say a traditional retirement plan says if you'll put $10,000 into that retirement plan, then you'll get a tax deduction in the year of contribution. So let's just say you're in a 30% tax bracket and you put $10,000 into an IRA, then you would receive a $3,000 tax break. And then the money in that retirement plan, let's just say you invested in the stock market, or if you had a self-directed IRA that was traditional, you can invest it in flipping houses, or you can invest it in rental properties, or whatever you want to invest it in. I'm saying you don't have to invest it just in the stock market. Now you do if you have a plan with Merrill Lynch or Edward Jones or one of those companies. But if you have a self-directed IRA, you can actually invest it in flipping houses and stuff like that. So anyway, but if it's traditional, you get a deduction for it going in, and then all the earnings earned in there, they earn tax deferred. Now, tax deferred means that if you have your IRA and you put it in there this year, 2020, and you don't pull it out till 2040, then any of the earnings that you have between 2020 and 2040, they're not taxed. They're tax deferred. And then they're taxed when you pull them out. So if we go to 2040 and you start drawing money out, then any earnings and any gains that you had in there, you would pay tax on them. Now, the theory behind that is that you'll be in a lower tax bracket in the future. Now, that may or may not happen. Now, I don't know about you, but 20 years from now, I don't want to be in a lower tax bracket. I'm hoping in 20 years, I'll be in a higher tax bracket because I'll have earned more money and I'll continue to have multiple sources of income coming in from many places. So a traditional plan might not fit me if I think my income is going to go up. But now a Roth IRA, which could be a Roth IRA or it could be a Roth self-directed IRA, there are different ways set up. That's where you put money in and you don't get a tax deduction today. So if you contribute $10,000 to it, you don't get a tax deduction, but then you don't ever pay taxes on any of the earnings. And so you go out to 2040, unless you say that your 10,000 grew to 25,000, you want to draw it all out, you would have made $15,000 over 20 years, which would be a pretty bad investment, but you would pay no tax on that. So you got to understand there's two thoughts of mine here. One is, should I be in a Roth IRA? One of them, should I be in a traditional IRA? And then from that, there are different SEPs, simples, 401k, so forth and so on. Now, I suggest that you get tax advice on this from a tax planner, along with financial advice from a financial planner. Because the financial planner understands all the different types that you can get, and he can do all the paperwork to make sure you get set up the right way, but he may or may not know all the tax implications of what would happen. So I really encourage you to make sure that these two people, your tax planner and your financial planner, get together, talk, communicate, and work together. And if you don't have that current relationship, you need to find that relationship. Because if you have a financial planner that does all your planning work outside of your tax guy, then they'll be in competition with each other. Because people try to do things that conflict. And financial planning and tax planning can conflict when it comes to 401ks, simple, and SEPs. All right. Missing family employment. This is another big mistake people make. Not hiring your kids when you first started out in business and everything, or when you have a business, could be a very big tax mistake. If you go back in the code originated in 1913. In 1913, the code was basically enacted. And in 1913, about 90% of people in America were self-employed in a family-owned business. And so you pretty much started working in your dad's business, your mom's business, your grandpa's business, or something like that. And so hiring kids was a very normal thing. I mean, you put them to work. And in fact, that's the whole idea of letting your kids out for school in the summertime, is because that was the harvest. And so they were needed at the home, you follow me, because that's when you plant and you reap and everything else. And so you couldn't be in school because they couldn't work. Well, you can actually pay children once they reach the age of 7 to do work. And they can earn up to $12,000 a year here, as you can see, tax-free. So if you actually paid your child to work for you, you could take the money out of your business account, you could pay them. Now, it's their money. You can't use that money for their support or their food or their shelter, but you can use it for that travel ball that they want to play, or you can use it for that extra band stuff that they want to do, or their extra football careers and C-ball they want to play and everything else. You can make them pay for themselves. Now, this is an interesting concept. How do you pay your kids to do stuff? What would you pay a 7-year-old? Well, there are some restrictions on this. Therefore, you got to do proper planning, but you get to pay them commensurate on what they earn and commensurate on what they would be paid in the market. Now, here's a very interesting thing to bring up, because it didn't exist 25 years ago, but, and just as rhetorical, I know you can't respond, but how many of y'all, when everything goes wrong electronically, look to your kids? How many of y'all, when it comes to websites and posting stuff and Twitter and Facebook and all that kind of stuff like that, look to your kids? And if any of y'all out there have ever hired a firm that does that, they charge a lot of money for systems. What do you call it? I can't think of it. When the SEO fees and so forth, where they want to make sure you're optimized on your website, to make sure that you're branding yourself on Facebook, you know what I'm saying, to make sure that you're using Facebook ads the right way. Kids understand this stuff. And if you hire a professional in that market, you're going to pay them $100 an hour. Well, what if your child's 10 or 12? We can't really pay them $100 an hour. They're not a professional, but we could pay them $100 an hour times a reasonableness rate based upon their age, and that might be $50 an hour. So what if we pay someone $50 an hour, a child, a 10-year-old, to help you for, enough to make $10,000 a year? Well, then you can avoid that in taxes. Now, I have 6 kids. I have 5 boys and a girl. And the cool part about this is you can start at age 7, and they can earn from age 7 all the way up to age 18, and they can avoid all taxes on it, FICA, federal, state, unemployment, and everything, all exempt. Now, this may or may not fit. This doesn't work in an S corporation, by the way. It does work in a sole proprietor, it does work in a partnership, and it can work in a C corporation. So your entity matters again. But this is a great planning tool here. And if you think about it, you can shelter a lot of income, but you do have to have reasonable wages. You got to have a written job description. You got to be able to show they actually did some work. You have to set up an account, an UGMA account set up in your name and their name, you follow me? And you can have savings in FICA and FUTA and so forth. This is a really, really good thing that you should look into to see if it fits your situation. It may or may not. Now, this brings up one point before I move on, because I didn't bring it up and I need to bring it now. You cannot take a tax deduction for the pure reason of the tax deduction. I want to make sure this is very clear. In other words, I can't show you an idea tonight, and the reason that you decide to do that is because it'll save you money on your taxes. That's actually against the law. You can only take a tax deduction that has a business reason. There has to be a business purpose. You have to show that there is a business reason for you to do something. Now, if there's a business reason how you can show that you can hire your children, and by hiring your children, they can earn money, they can learn a work ethic, you follow me? They can help you out. It really would do something. Then you can hire them if there's a business reason. And then there is a tax benefit of that. But you can't do things purely for the tax benefit. Does that make sense? Hopefully it does. I'll touch on that later on questions and answers if you have it. But it's very, very important that you understand, you don't just take tax deductions for the tax benefit. You have to have a business reason behind what you do. But then if there's a business reason, then guess what? You get the tax benefit that applies to it. All right, missing medical benefits. This is also a very old code section. Most people have forgotten about it. There used to be a time before insurance. So let's go back to 1913 when they first enacted the code or whatever. There wasn't a lot of insurance. We didn't have insurance like we have today. And basically there was like an understanding that people didn't call in sick and everything else like that. They weren't doing it. They didn't try to manipulate the system like a lot of times happens today. But basically back in like 1913, if you came to work for me, I'd say, hey, I'll pay you $40,000 a year. And I'm willing to pay up to $10,000 a year on any expenses you incur for you and your family for medical and health and things like that. Because things do happen, you know? And it was like in a contract. But one was your salary of $40,000, and the other $10,000 was basically, it was a fringe benefit. And it was a contract. It was a medical expense reimbursement plan that you would sign. That's called a MERP, medical expense reimbursement plan. And I would pay you $40,000 plus I would sign up with you with a MERP. And it would be, listen, I'm willing to pay you or reimburse you for up to $10,000 of cost annually. And so medical expense reimbursement plans have been out there. There's actually section 105, if you want to Google this and look into it. There's section 105 of the Internal Revenue Code. Now that's a pretty important thing because the Internal Revenue Code starts, you know what I'm saying, with zero. And it's 1, 2, 3, 4, 5 in sections. And section 105 would be a very old section. Now, this is not used much today. But a medical expense reimbursement plan can take a lot of medical things that were not allowed as a deduction that have been denied or made to put on forced to put on Schedule A as an itemized deduction and make them deductible. Now, I'll give you an example so you can understand how you can apply it. And then you just think about it as it fits your situation. And this is something you should look into for tax planning. But my son was actually born with a lazy eye. One of my children, I have 6. And one of them was born with a lazy eye. And when he was 2 or so, we were talked into doing some surgery for him that will never happen again, ever. And they put him under and they did the surgery. And when he came out of that anesthesia, he freaked out. It was probably the most scariest moments of our entire lives because our son was losing it because he had gone from anesthesia back to the real world, if you want to call it. And they didn't fix the problem. But they said he was going to have like 7 or 8 more surgeries to correct this problem, that this was just a process, and he would never have full vision. Well, we didn't believe him. My wife refused to believe him, so she went and started looking for alternative medicines. She started looking for alternative ways to change his eyes. And she found that. She found vision therapy, but none of it was covered by insurance. And insurance wouldn't touch it because it wasn't medical. It was alternative. But now this stuff costs like $25,000 to get this work done. And it was over a couple year period, and we paid that money, and we set up a medical expense reimbursement plan, and we deducted the cost of that medical stuff because it was allowed. And today, my son has perfect vision. In fact, he has better vision than I do. We go hunting, and he shoots better than I do. He's in the Air National Guard, and he passed all their vision tests and everything else. All because we didn't want to have him have to go through surgeries. But it brings up an interesting situation because insurance wouldn't cover it, but it was a medical expense that would fall under a medical expense reimbursement plan. And so therefore we set up that plan for our company, and then we deducted those costs associated with that because we legally could. This same situation could apply. Maybe you're taking care of an elderly parent. Maybe you have a parent that you pay some of their medical bills and so forth. Well, if they could do some work for you and they could help you with their work, I'm saying, then you can set up a medical expense reimbursement plan for them, and your company could pay for those expenses as you pay them out of pocket. Now, there are rules with this, and you have to follow some procedures, but this is a very, very good tax deduction that most people don't know anything about, and they should look into. Missing a home office deduction. This used to be a very, very audited area. The Internal Revenue Service back in the 70s thought that no one should have a home office. There was no way you could have a home office. And they used to audit it all the time. And it was one of those things that if your return got filed, you had a home office, that it was flagged, they were going to audit your return to try to take away that deduction. Well, in the 1990s, when people started having personal computers and stuff, that kind of changed. And by the 2000s, now the IRS recognizes this is a real deduction. Everybody can work from home. Mobile commerce is a big deal, and a lot of people can actually run their entire business straight from their phone. It's really kind of crazy. There's some really crazy stuff out there that you can do, really cool stuff with technology. But the IRS started giving you a deduction. They said, basically, we're not even going to audit this anymore. If you want to check a box, we'll give you up to a $1,500 deduction. Now, my little spidey sense goes off when the IRS says, we're not going to audit this anymore, and we'll just give you this deduction for this. You should start saying, I wonder how much the real deduction would be if I actually kept records. And the real average of a deduction for home office is around $5,000 or $6,000. So if you'll actually keep your records and actually track what you're doing and actually apply your home office deduction the right way, that's a $5,000 to $6,000 deduction you should take every year. That most people, when they're doing their return, they'll just check a box and say, well, I'll take the safe harbor, and they'll take a $500, $1,000 or $1,500 deduction. But in reality, their deduction was probably closer to 5 or 6, but they don't know how to actually take that deduction. And a lot of times their accountant will say something like, well, it's just easier to go ahead and take the standard deduction on that, take the safe harbor, it's better. Now, don't be wrong. I've got some clients of mine that when we work through the calculations, it's better for them just to go ahead and take the standard deduction, if you want to call it, or the safe harbor. But the average person has $5,000 to $6,000 for the deductions, but we don't know where you are until we actually look at your circumstances. So don't just miss this deduction by checking the safe harbor. Look into it, make sure you're doing it the right way. All right. Missing car and truck expenses. This is really a big deal. And so most people that work, transportation is one of their biggest expenses. I mean, let's be realistic. I mean, cars cost almost as much as houses used to. I mean, my father-in-law purchased his house in 1966 up in New Jersey, Cherry Hill, New Jersey, and he paid like $30,000 for his house, or maybe 40, maybe it's 40. Now you can spend that on a car today. And some people go, you can spend that on, a half a car today because I wouldn't even pay it off. There are people, cars today got it really out of hand expensive. And so because they're so out of hand expensive, a lot of people don't understand that there's two ways in which you can deduct the cost. There's two main ways to deduct travel costs through transportation. One's called the actual car expense way, and the other one is called the mileage method. So I'm going to go through them real quick with you, just to explain what they are. I'm probably going to leave a couple of you in the dust here, and I'll get too technical with you, and your eyes are going to glaze over. But for the ones that are really detail oriented, you're going to be like this. You're going to eat it all up. Okay, so the actual method, here's what you have to do to take a deduction for car expenses. First of all, you have to prove that you own the vehicle. In an IRS audit, if you don't own the vehicle, then there is no deduction. So if you're actually using somebody else's car that's not titled to you or not titled to your business, then you're not going to get a deduction and audit for it. So the second thing you must do after that is you must show the IRS, after you show you own the car, you've got to show all of your expenses associated with the car. So they want you to have tallied up and kept records of every time that you bought gas, every time you got a repair, time you got it clean, you follow me? Anytime you had to change the windshield or change the tires, whatever. So you take all your actual cost of gas, oil, repairs, everything, and you total those up. And then once you get them totaled up, then you'll have a number. And let's just say your number is $10,000 for sake today. Or no, I'll take it back. I should use a better example. Let's just say it's $6,000 with all your costs. And let's just say that you paid $20,000 for your vehicle, just as a simple example. So if you paid $20,000 for your vehicle, well, in most cases, there are exceptions to this. The IRS requires you to depreciate that vehicle, which means you have to allocate the cost over a certain year time, which means for most people, the car has a 5-year life. And so if you pay $20,000 for a car, then under the actual method, you can take basically a $4,000 deduction each year for 5 years. Now, the rules on this are really a little bit different. You follow me? Just trying to make a simple example for understanding. But so basically, you get a $4,000 depreciation deduction in year 1, a $4,000 in year 2, year 3, year 4, year 5. So your total deduction for 2000, if we're doing 20 this year, your total deduction will be the $6,000 and what it costs you to operate your vehicle, plus your $4,000 for your depreciation. So your total is 10,000. However, there's another calculation that most people don't know they have to have. And that calculation is the IRS wants to know how many miles that you put on that vehicle for the entire year. And of that, how many miles were business. So in other words, the IRS wants to see your service receipts because they won't take any other information from you. Then we get your service receipts. And the service receipts will say that if you got one in January, got one in June, got one, whatever, you'll be able to add them all up and see how many miles were put on the car. So let's just say that you had 25,000 miles put on the car, of which 20,000 miles you say are business, and the other 5,000 are personal. Then that means that you would have 80% business use. But the IRS doesn't stop there. They actually want to see your travel logs. Yes, they want to see where you left from house to here, to there, to wherever you went, and the business purpose. So why did you go here? Why did you go there? What was the business purpose? So if you don't have your travel log to support your total business miles that you want to say, remember I said your car receipts, your service receipts show you drove 25,000 miles, but then you said 20,000 was business. If you don't have a travel log that shows 20,000, then you're not going to get an 80% deduction. You're going to get a 0% deduction. Yes, a 0% deduction. But let's just say that you have travel logs, and those travel logs show that you drove 20,000 miles, and you drove the car for 25, but 20,000 is business. So now 80% is your deduction. 80% of the 10,000 we talked about before means you got an $8,000 deduction. So that would be how you calculate car and truck expenses. The second method would be the mileage method, which is everything we did at the end. You determine you had 20,000 miles of business miles. You show your service receipts that show there's really 25,000. You have your travel log for 20. We take the 20,000 miles, and I forgot the number, times point, I think it's 57.5. Then that'd be an $11,500 deduction. Now, would you rather take an $11,500 deduction or an $8,000 deduction? Well, most people would rather take an 11. So, but you have to determine that for each car usage in the life of the car, either the actual method or the mileage method. And what this is pointing out here is that the mileage method doesn't always run that way, though. Like I gave an example where the mileage was higher, but a lot of people don't drive 25,000 miles. And if we drop it down all the way to 15,000 miles, of which only 80%, 12,000 is drivable, then 12,000 miles times 0.57 is going to be $6,800. And we had 8,000 with the actual. So we don't know which is the right way to take your automobile deductions until we actually calculate both. And most people never do this exercise. And 90% of people that I'm talking to probably on this call don't keep travel logs. And even if you keep a travel log because you use some kind of app that might help you, if you don't have where you went and the business purpose, then it's invalid or it won't be accepted from the IRS. All right, moving on. I put meals and entertainment here because entertainment's still out there, but it looks like that that Trump will not be reelected. And I'm not saying that from the political. Trump wants entertainment to come back. So it was going to be part of his legislation that he was going to try to bring entertainment back because he thinks entertainment of business is exactly how businesses are supposed to run, that you must entertain people. And that's just how we socially gather, and then we decide we like someone and then we do business with them. But entertainment right now has been taken away, but meals have not. So I want to walk through the meals deduction with you and give you some insight on that because a lot of people mess this up too. And in an audit, they'll have a real big problem. And so missing meals is a big deal because if you don't deduct them all, then you missed it. However, you cannot go out to eat with a business client and deduct it. If you say that language, then it's not deductible. Here's the language that's not deductible. Well, Bob and I went to Panera Breads and got something to eat. And while we were there, we talked some business. That's not deductible. See, for it to be deductible, the main purpose of the meeting was to discuss business. So if you use the language that Bob and I went to Panera Breads to get something to eat, and while we were there, we talked business, therefore I'm going to deduct it, you're wrong. and the IRS will deny it. Here's the way it has to be worded. Bob and I went to Panera Bread to talk business. And while we were there, we got something to eat. There's a difference. If the main purpose is to go get something to eat, then that's not business. If the main purpose is to go there to discuss business, and then while you're there, you eat, you can deduct the meal. This is very important. Now that sounds like games, doesn't it? It sounds like semantics. Sounds like we're just playing word games. But the IRS is pretty particular about their word games. Remember about being compliant and everything? I mean, they want you to be compliant. So you can't just deduct business meals. You have to have a meeting of which you can deduct the meal if you had one. Now, the cool thing is, it's not hard to prove this if that's really what happened. Because let's be realistic, most people do meet for lunch to talk about business. You just have to remember, you have to meet to talk about business and then have lunch. So in other words, the lunch happens to happen. The meeting was going to happen whether you ate or not. All right. So who can you deduct? Well, this is really cool. Clients, prospects, referral sources, anybody you want. And pretty much you can deduct anybody that you might be a former client, a potential client, a future client, I mean, and or potential client. I mean, we go all over the board about who you can meet with anybody that you might be doing business with, but the purpose of the meeting was to discuss business, and then you ate. Now, unfortunately, you only get 50% of this deduction, and you're about to lose the whole thing in the next year or so. So pretty soon, this won't even be a deductible thing either. You won't be able to eat out and get a deduction for it, which is completely crazy. You can't entertain at home. You don't have to go out. You can actually have someone come to your house. You can fix a meal, and you can actually deduct the meal there. What do you have to keep in records for now? Well, there's 5 things now. Remember I told you the 4 before, the unofficial rules. You have to have the time, the place, the amount spent, the business purpose. Well, there's one more when it comes to meals. And that one more is who with. So if you take your receipt, you went to Applebee's, you spent $40 on lunch or dinner or whatever it might have been, and the Applebee's receipt shows the time and the place and the amount spent. You need to write the business purpose in there and who with. And here's one more piece of information. The business purpose can't be general. And what I mean by that is you cannot say business lunch. That's considered to be a general statement. And your meeting had to be very specific to talk about business. So therefore, you need to say something like to discuss marketing, to discuss listing, to discuss closing, to discuss terms. I would use the word to, T-O, discuss, D-I-S-C-U-S-S, to discuss, and then put the business purpose. And then you need to have the person's name on it. If you'll do that, then you'll be able to deduct your meals as you go out there, not your entertainment anymore, because entertainment's not allowed. Okay. And it might not come back. And meals will soon disappear under the current plan also that expires 2020. Actually, I can't remember now. I'll have to look it up. It expires soon though. Anyway, so let's move on to the next thing. The 10th thing, which is kind of, a little self-promotion of Jeff. I discovered this situation, and I'll tell you how I got my business started. Is that I ran a CPA practice for many years. We had a really good practice, but we tried to do all the things that we thought our clients needed and our clients wanted. So we didn't just do tax preparation. We actually did tax planning work. We actually did audit proofing work. In other words, we helped people understand how they would be audited and what they can do about it. And then we also did the tax preparation. And over the years, I found out that I hate tax season. I hate it with a true passion. I do not like the idea of having to work 100 hours a week, 10 to 12 weeks a year. You're paying every single year. And so I started a very unique practice a while back in 2003. And in 2003, what we started doing is we started doing what we called a business checkup. And a business checkup was we found a lot of people need some business coaching on how to get off on the right foot, how to get things set up for the right way, how to make sure they don't make mistakes. I mean, especially if you're going to go into business and you're going to spend $5, $10, $15, $20,000, you want to get started on stuff. You want to make sure that you deduct things the right way. And when you get an income stream coming in, you want to make sure that you pay the least amount of taxes legally possible. And the only way to do that is with planning. And then most people could not survive an IRS audit. So after we helped a bunch of people through a bunch of audits. You know what I'm saying? We actually picked up clients. Hey, I'm being audited. Will you represent me? After going through a bunch of audits, we recognized that the way the IRS audits is not the way that the preparers tell people they do. And most people are really caught off guard from it. So we actually started offering a service a while back where we could actually just audit proof your return. We'd come in and look at your tax return. We would then look at all your records to support your tax return, and we would tell you what would happen with the IRS. And then we would continue on, like I said, doing tax prep. Well, eventually I've worked myself to the point that I don't want to do tax prep anymore. And I will do it. I can do it. You follow me? It's not like I'm not, I can do it, but I actually, I refer it out. I work with a lot of CPAs in town, and they love me because I work with a client and I actually take that client, we set them up in business the right way. We put all their records in QuickBooks and show them an accountable record keeping process. We then do tax planning work for them and make sure they take every deduction they're legally entitled to. We show them through implementation guides how they can take those deductions for the home office, the rental use of home, the car, everything else. We show them how they can take those deductions and keep all their records so that they got audited by their IRS, they'll be okay. And then we actually then send you off to a CPA firm typically to prepare your return. Or if you actually, quite honestly, and it's very rarely I ever say this, we normally get it so clean that you could actually use TurboTax or something probably to prepare your return, even though I don't recommend that you do that. So we have a service, we call it a business checkup. And it's true tax planning, it's real audit proofing, and it's practical business advice on your family, home, and job business investments. We'll actually review your returns to see if there are mistakes made in the last 3 years, that we can actually amend those returns. Because if you overpaid your taxes in the last couple of years, you have 3 years to amend mistakes or correct mistakes to get your money back. And so we offer what's called a free tax checkup. We'll do a free tax analysis and we'll look at all your information and we'll see if we can help you or not. And if we can help you, if we know that we can help you, then we'll put together an engagement letter for you and we'll work with you for the next 6 to 12 weeks to actually teach you and educate you on what you're supposed to do. And that's pretty much what I've been doing since 2003. I love what I do. I love helping people. I love people understanding their money and understanding how to keep more of it. And so I would say that your 10th biggest mistake that you make, it's a self-promotion. So I apologize, but it's that you actually had a business checkup done for your business to make sure that if you're going to try to make some money through business, that you keep everything that you can keep. And our whole goal is to help you make more money, save more money, pay less in taxes, and of course, get out of debt as soon as possible. And that's the philosophy of TFL Worldwide, which stands for Teaching Financial Leadership Worldwide. So I appreciate you guys letting me share tonight. I'm going to open it up now, I guess. Bob, if you want to be the coordinator of this somehow, I'm going to open it up and I'm going to stop sharing my screen. And I'll be glad to answer any questions or try to keep answering some questions for the next 10 or 15 minutes if anybody might have. But thank you very much for letting me speak. And I really hope that you will get proper tax planning before year end. I know that today is the 14th and you may think you don't have enough time, but you really could get some things done between now and then that might save you $1,000, $2,000, $5,000 in taxes. So anybody have any questions? Bob, you want to control this question and answer?
Yeah. Thank you, Jeff. I appreciate it. This is really good stuff. I saw some places where I can save myself, but thank you. Does anyone have any questions? Does you like to ask Jeff? I mean, his time is actually pretty expensive, so this is a great time to catch him if you have questions. Huh. Maybe not. Oh, Prince Panford's asking your contact info, Jeff. Let me.
If you could post that on the website, I mean, I'll give you my email address is J as in Jeff Harmon, HARMON, and it's at TFL, which is the name of our company, TFLworldwide.com. So it's jharmon at TFLworldwide.com.
Jeff, I'm going to put that. Yeah, I'm going to put that in the chat also.
All right, and my cell phone number, if you wanted to reach out to me or whatever, and text me, and I'll be glad to talk to you. is 803. He just put it there, 727-0400. You might want to take that PH off there. Oh, there's his phone. I'm sorry.
Is that okay, Jeff?
Yeah, your chat's good. I was just looking at it. Okay. So,
Okay.
but
Okay.
no,
Does anyone have any questions for Jeff while he is live? After this, if you need tax planning or business planning tips or whatnot, I don't think it's going to be as cheap as what it is now. So,
Good afternoon, Bob. I have a question, if I may.
yes, Wesley.
Jeff, today I was actually met with my tax advisor, my accountant, and we were discussing some future taxes. So the way I say that is I started another business besides the real estate. So it's a separate S corporation, and I'm doing government contracting. The contract is relatively new, as government contracts are usually let in the first quarter of their fiscal year, which was October. Excuse me. And so, or the end of the other year, and you start in October. So I started September 25th, and thus will have a small amount of income from that contract. So at the end of the year, my question to her was, would it be better to carry a loss and pay myself the salary needed to max out the 401ks for myself and my wife, and carry the loss over into next year, knowing that in the long run, at current tax rates, I will pay more money because I'm got FICA tax. But in the long run, under the assumption that tax rates may go up higher under the new president. Am I explaining that right? Does that make sense? I mean, right now I'm in the 32% tax bracket, but I assume that might not stay there.
Let me walk through something, because and I'm apologizing if I'm about to insult you. Okay. I have the gift of insult. So like I said, I'm going to try to work through this. This is a perfect example of not talking to a financial planner and coordinating a financial planner situation with an accountant. Now, and so I'm going to try to re-say what you said. And if I'm off, correct me. But maximizing a 401k requires that you have salary income. To maximize a 401k, you can't have an S corporation have distributions from it. You have to have what's salary income, which means that you take a salary of which you can't take any deductions from. So it's not like business income, where if I made $40,000, but it cost me $21,000 to make it, then only have $19,000 of profit. When you have a salary income, it's taxable income, and there are no real deductions against it except the standard, pretty much. And you had to pay 15.3% FICA on that money. And so you're gonna take, and let's just take it's a $20,000 salary. You take a $20,000 salary so that you can put $4,000 in a 401k, but it costs you $3,000 in FICA because you own your own business. Your company is not matching your FICA, you're matching it, you follow me? So when you take that $20,000 FICA, $20,000 salary, you have to pay 7.65%, and then your company has to pay 7.65%, which is 15.3. So you just paid into the government, into their retirement program called Social Security, $3,000 for the right to be able to deduct $4,000 on your tax return, in the hopes that that 401k is going to earn that money over whatever period of time. And then when you pull it out, you're still going to be taxed on it, but you're going to be in a lower tax bracket as opposed to a higher one. So when you mess around, it's a terrible word. 401ks fit very well and do really good things. But 401ks, I would say to most people, are kind of like fires, or they're like stovetops people left on that don't know they left them on. And if they're not careful, they could burn their hand. Have you ever left your stovetop on before and forgot you left it on and then touched the top of it? You don't do that but once. And then after that, you check to see if it's hot. Now, you're a consultant, which means you're getting to have, and I recommend the S corporation setup, but your salary is subject to FICA, so you have to have a reasonable salary with it. But there's a mix. And we have an implementation guide for it. You follow me? We actually walk you through an exercise to show you exactly where's the maximum benefit of putting money in a 401k as opposed to putting money, and not putting in a 401k, from the cost of FICA to the cost of investment and the return on investment. And I think that my advice to you would be to get with your CPA and your financial planner and to get them to work together to give you a projection of the cost savings analysis of your FICA versus 401k investment and then return on investment from the 401k. Did I lose you or did this make sense?
No, it makes sense. And we have done those projections. I guess I may not have been very clear on my question. And so I guess my question really comes down to, being it's the first year, my accountant has advised that it could be acceptable that I take 0 salary this year.
Absolutely.
Thus, all of the money on my, I believe, K1 would be subject to the 20% 199A. I believe that's the right rule, correct? The 20%. And then, or the other option would be to take a loss and pay myself and the FICA, and so that and put the money in the solo 401k. And I understand that's a tax deferred account, and the thought of carrying over the loss would be that on the tax projections, if everything stayed equal today with tax rates the same, as you said, I believe the numbers was something about $5,000 I would be paying more in the actual tax burden when taxes came to fruition. However, if the tax rate went up to, let's say I go from the 32% bracket to the 40% bracket, it starts to diminish greatly, very quickly by carrying that loss over the next year. I guess my question to you really is more, do you predict that rate will go up substantially next year and maybe even the year after?
I'll give you my insight on that. Now, this is just my insight. This is my intuition, if you want to call it. So, and I'll talk about the political thing. So you can't really see it out because it's going to be January before you know. If the Georgia House stays Republican and the Republicans maintain the Senate, then Joe Biden will have a hard time getting his tax plan through Congress and the Senate to get to the presidency, which means in 2021, I don't expect to see a lot of change in the tax laws. If the Georgia House flips, you follow me, the Senate, you know what I'm saying? And they win those 2 seats, then Joe Biden will have the House, the Senate, and the Congress, and we will have sweeping tax change in 2021. Now, my personal insight on that is he's not going to win. Georgia's not going to flip. Both seats are not going to go, you know what I'm saying, Democratic. And I'm not trying to be political here. When I talk about politics, I'm talking about the effect of taxes. I'm not talking about policies, procedures, belief systems or whatever. I'm talking purely taxes. I don't think that that's going to happen, which means I think that the Senate is still going to be controlled by Mitch McConnell, and Mitch McConnell will do everything in his power to slow down anything that Joe Biden does. Just the same way that that's happened this year. The House is, they go back and forth. They're against each other. You follow me? So I think the answer to your question is, I don't think you're going to see a major tax increase in 2021. Now, 2022, you'll have the midterm elections, you follow me? And you could see, if the House seats flip that way, you could see that change. And it could go either way again. It could go that they lose House seats or gain House seats, you follow me? Politics matters when it comes to taxes. That's what I'm trying to say. And I know I'm not giving you the best advice, except to tell you, I don't think you're going to see a very large increase in taxes in 2021. But I think depending on how things go, you could see that turn in 22 and 23. So that should be a fudge factor for you in your decision making. Did that help?
It helps greatly. Thank you.
Okay, does anyone else have any questions for Jeff? Because if you don't, I have a question. But does anyone else have a question for Jeff? Oh, George Fogel's asking, Jeff, what part of town is your office in?
I'm in Lexington.
So is George. It's a good match.
I live in Lexington.
Okay, George says cool. Okay, does anyone have any questions for Jeff before I ask mine? Well, okay. Okay, Jeff, this is actually for a friend of mine. She took it's for a company up in Charlotte, actually, Charlotte, North Carolina. and she took a buyout package, if you will, where after she left the company technically this year, and she has another year of full salary. Now here's the situation. She has savings. She wants to start a mobile coffee shop, and she already put a down payment on the trailer maybe about a week and a half, 2 weeks ago, for them to fix this thing up. She won't finish paying for it until next year sometime. Do you think it'd be best? Is she now she already put the down payment in? Is she allowed to push that expense off into next year if that's to her best benefit, or does she have to do it this year? Because she doesn't have any income from this coffee shop, so there's nothing to deduct from.
Yeah, but it would create a loss and go back against her income from her W-2 salary. There's two things to think about there. And like I said, if I don't answer the question totally or I miss the base here, but I think I understand what you're saying. First of all, when it comes to purchasing equipment, there is a rule there about when you place it in service. And so you're supposed to purchase it and place it in service at the same time, but a lot of people don't. So therefore, you can't deduct it until you buy it and place it in service. But it also creates a very good tax planning thing, because you could buy something in 2009, and we're in 2020 right now, and you could place it in service in January. So to answer your question, does she have to take the deduction for it? No. She could take the deduction for it next year, because she could have put money down on it this year, and then she could place it in service next year, if that's really what happens. So there's some rules on what place it in service means. Now, from a tax standpoint, let's just say, and I'm just throw numbers out there because I don't want to just expose her numbers to everybody, but let's just say that she made $100,000 this year in her job salary, and this trailer cost 20 grand. Well, if she actually did put a down payment of 20 grand for it, you're saying, and I'm saying the down payment was 20 grand, the down payment, and she was going to buy it, and the trailer itself cost 45,000. If she placed it in service and that was a real business asset, then yes, she would be able to take, through Section 179, a $45,000 tax deduction against her $100,000 worth of earnings this year. But let's go back to the thing we talked about, the presidency. Her tax bracket would only be at $60,000 would only be 12%. And let's just say next year she makes $200,000 with her coffee shop, and she's in like Wesley was saying, a 32 or 35% tax bracket. Well, she took that $45,000 tax deduction and got a 12% benefit from it. You see where I'm going? And then if she'd have waited till 2021, she'd have got a 32% benefit for every dollar. So when you deduct something, it is extremely important. And so I don't have enough information here on this case to say what you should do yet. But yes, you could take the deduction in 20. You could take the deduction in 21. What's your tax bracket you're in right now? What's your projected tax bracket you're going to be next year? And then you do an analysis to try to figure out, with the information you have, what's your best decision.
So even just putting a down payment now, if she wanted to, she could still take the full deduction this year.
Yeah, if she put a down payment on, she purchased it, if she's got a right to purchase it. But now you remember, is it placed in service? You got a placed in service rule. You can't put a down payment of $1,000 on something and then you're not going to receive it till a year later. 6 months later. And you got some rules there you got to follow with when's it placed in service. But most of those rules she could probably easily meet by saying, I'm willing to do this, or I'm willing to do that, or willing to do. There's some circumstances. So yeah, she could take a down payment. That's no different if you bought a car. Let's just say you went, the example you just gave me, the same thing. If I went down and bought me a new Expedition or a new Suburban, okay, and I could put $1,000 down and pay for it for the next 5 years, but I get the full deduction for buying it for putting the $1,000 down.
Okay, or she could push the purchase price.
Or she could say, I put $1,000 down, but I'm not placing it in service until January of 2021. And then I could take the full deduction in 2021 against that.
So it really
depends on her income.
Okay, and that goes back to what you're talking about, the wording and all that.
It does, well, the wording and how it's done. That's exactly right.
Okay, thank you, Jeff.
Does that help? I hope I answered that question.
It does. At least it shows there's the option if she does it right. there's the option she can deduct from, that's still big a crapshoot though. What's going to happen in the tax laws with Biden in office. It's a bit of a crapshoot.
It is, and that's what planning is about. We have to plan based upon the information we have and then make the best decisions. And when we just wait until and this is why I say, why you can't get good advice from a CPA in February. And here's why. The year's over. When you bring him all your stuff in February, your tax year's over. There's no decisions to be made. We have a fact pattern, you follow me, that ended on 12/31 that can't be changed. See, right now, everybody on this call right now has the ability to affect their year-end tax planning because it's not 12/31 yet. But once it turns to January 1st, you're saying, then you can't go back and say, well, I really wrote a check here, really wrote a check there. You can't change the past. So tax planning occurs in the year you're in. And most people get their tax advice. They take all their stuff to their accountant around January, February, and then they wait for the result. And I'm saying that you have, 17 days left to actually make changes and decisions. And one of those, for that person that you're talking about, wants to set up that coffee shop, a mobile coffee shop, how they're going to treat that piece of equipment is still up in the air about how they should do it. It's still up in the air. It still can be decided to their benefit.
So she has until the 31st, basically. But thank you. That's very helpful.
All right.
Is there any other questions? Speak now or next time pay Jeff a lot. Okay, realistically, Jeff also holds meetings at the Chamber of Commerce every Tuesday night as well. So if from 8 o'clock typically. So if you want, well, Jeff, it's okay. I'm going to put myself out on a limb here. If you want more free tax advice, that's a good time to show up. So.
Well, we do have a meeting tomorrow night. We're not doing one the rest of the year. We're done. Tomorrow's our last one for the year. But there is a meeting tomorrow night at the Chamber of Commerce, Lexington Chamber of Commerce. It's going to be on the 3 keys to wealth, though. It's going to be on what we call financial literacy, which is how to make more, save more, pay less in tax, get out of debt as soon as possible. And it's going to be on leadership, how to lead yourself and lead others. And it's going to be on leverage, which is learning how to do systems-based thinking as opposed to skills-based training. And that all centers around a product that we promote and we sell at our company. It's called the Life Super App. And so I have a guest speaker actually coming in. His name's Lyndon Bell. He's my mentor. He's one of the people that taught me how to make a lot of money. He's actually coming in from Atlanta tomorrow, and he's going to be doing that presentation at the Lexington Chamber of Commerce. And we will get started promptly at 8. If you would like to come, since you were on this presentation, and hear some information on what we call the 3 keys to wealth, you can come as my guest. Just when you get to the front desk, whatever, instead of having to register and check in, just tell them you're a guest of Jeff Harmon, and they'll put you on the guest list. And I'll love to meet you, and I'll even get a chance to introduce you to the speaker if you want. Lyndon Bell is a highly successful business owner. He's got a national business all over the country, and he speaks all over the country actually. And he's actually working on a book and so forth also. So really, really sharp guy that's going to be doing some coaching and teaching tomorrow. And if you want, you can come as my guest. It is a paid event. You're supposed to pay to come, but if you want to come tomorrow as my guest, you can sign in as a guest tomorrow. Just tell me you're a guest of Jeff Harmon. Thanks for that shameless plug, Bob, but I appreciate it.
It's interesting. I didn't realize there's a paid event first. So I went to like the first 4 events free as a guest of Jeff Harmon. So, but anyway, but thank you, Jeff. Does anyone else have any last questions before we sign off here? Jeff, I think you have satisfied everyone's needs for tax planning, but thank you very much. I appreciate it.
Awesome. Y'all have a great night.
Okay. I'll see you tomorrow, Jeff.
Great training.
Absolutely. Thank you.
Bye.
Thanks, Bob.
Thank you.
Thanks, Bob.
Thank you, folks.